Hi, how are you doing, Abhishek?
Excellent. How are you?
Doing great.
And how was the trip to India, Mohnish?
Oh, India is always fun, no issues. It was perfectly fine.
Excellent, excellent. So, Mohnish, I think we should start. Are you ready?
Sure.
Excellent. So, welcome to the Treasury Elite Entrepreneurship Series. Time and again, we bring in world-class speakers and business leaders across the world in the field of entrepreneurship, treasury, hedge funds, VC, private equity, and conduct various programs and webinars and conferences in different formats. Treasury Elite Entrepreneurship Series is one such format where we learn from industry thought leaders about their experiences of running their businesses, opportunities and challenges they encounter, and broad global trends they see for the future. Good morning, everyone. I'm Abhishek Goenka, founder and CEO IFA Global and Treasury Elite. We bring in one-stop FX, treasury, and wealth solutions for companies in India over the last 18 years. And today we have Mr. Mohnish Pabrai with us. Mohnish is a founder and managing partner at Pabrai Investment Funds, the CEO of Dhando Funds, and the author of Dhando Investor and Mosaic Perspectives on Investing. Mohnish and his wife Harina started the Dakshina Foundation with the goal of recycling most of their wealth back to the society. Good morning, Mohnish. How are you doing today?
Doing great. How are you doing?
Excellent. God has been kind, Mohnish. So, Mohnish, my first question to you is, what's your approach towards investing in global markets, Mohnish? In case a person needs to build a global portfolio in the current environment, what are the countries one should look at, and how should he design the global portfolio, assuming he can invest in most of the markets?
Yeah, well, I mean, I think the answer for most people is to index. And if a person in India were to just buy outside India two broad indices, the S&P 500 and the MSCI, I think that's assuming they have a long enough time horizon, they're young and so on. That's pretty much all they need to do. The frictional costs are low, and you can add to it as you need to, and it works well.
I completely agree with you, Mohnish. A lot of discussions lately have also been started that, since index investing has been in vogue, and of course, the global thought leaders have talked about it so many times. The PE multiples of investing at the index at times have increased a lot. Maybe people are talking about that active management might again come in vogue for at least next 2, 3, 4 years. Do you feel that it's little overrated in the current context?
I think the issue is that if you look on the active management side, um, picking a good investment manager
Yeah,
is much harder than picking a good stock.
right.
So the odds are very high that the typical investor will make a mistake in terms of the selection of the investment manager. And 95% of investment managers, historically have lagged the index after their frictional costs. So I think that if one is kind of doing an SIP approach or dollar cost averaging and so on, then I don't think that's much of a concern in terms of, and I don't think one should think in terms of 2-3 years anyway. So I think that's probably a simple way to go, is to go with the broad indices. And anyway, if you are young and you're earning, then you will anyway deploy over time. And so that should be fine.
Right. It's worked in the US, and I think US has proved it the best. In India, I think in the large cap category, I think we almost 80% underperform. Maybe in the mid and small cap category, I think still there is some overperformance in terms of active managers in India. But I think
Yeah, I
in
think
US,
I think in India you might want to look at the small cap index or the mid cap index,
mm, mm.
or maybe split it between small and mid cap.
Mhm. Mhm. Right, right. So, Mohnish, now there are two approaches of investing which is widely uh, taken across the world. One is a multi-country, multi-asset allocation, and the one is where you can just buy an index ETF, get an all-equity portfolio with the best stocks. So, assuming a family office is looking at a say a 5-6% return over inflation in a long term, which is a better risk-adjusted approach from your experience?
Well, I would say that this is an area where there is a free lunch. And so as you go towards more advisors and more sophisticated strategies, the odds of beating the simple index go down.
Yeah.
And so Charlie Munger says that if he lived in Peoria, Illinois, and he owned the McDonald's franchise, and he owned the Ford dealership,
Mhm.
and he owned the best apartment building in town. Let's say he owned those three assets. He said he would be happy putting 1/3 of his wealth in each of those and be done with it. And so when you look at that type of allocation, one can argue that it's not geographically diversified, which is true because it's all sitting in one town. But the odds are extremely high that he would end up with a great result.
Okay.
And so I think people get in the way of themselves by overly complicating things.
Agreed.
So I would say the default should be an index. And then if you run into something which is, just a no-brainer that is, better than the index or whatever else, you're able to buy a McDonald's franchise at, 5 times earnings or something. You could take some of it and put it into that franchise, for example. So I would say make the default the index, and then um, anything else, the bar is a lot higher.
Right, 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 right. So, Monish, in the current environment, when interest rates across the world have gone up so much, and we had a pretty good bull run in the last 13, 14 years, without major drawdowns, which actually stayed, it just went up because of printing. There is a huge, there's a camp which talks about that interest rates and taking duration for some time, maybe an 8-10 years duration, would start, giving better returns than equity, and large money has moved also into debt. So, what's your view, Mohnish, on this that shift which is happening because of higher interest rates?
Well, I've been an equity investor all my life. The history of investing in uh, debt instruments has not been a great one for investors in terms of their ability to stay ahead of inflation.
Mm-hmm.
So generally speaking, I would just think that if you were looking at a short time, 1, 2, 3, 4 years, then yeah, one should not look at equities. One should look at some type of, very safe fixed income. But if you have a longer time horizon, then I would still be on the side of uh, being in equities.
So you feel that earlier they were running a 70-30, 80-20 portfolio, probably move it to a 50-50, and then once you get better valuation, make it again to a 70-30 or 80-20, or
It depends on I think it depends on your age and time frames.
right.
But I would not put half in fixed income, for example.
Mm-hmm. Mm-hmm.
Um, I might ease it into the market, right?
Mm-hmm.
Even if I put half in fixed income, I would say, okay, you know, put a certain amount into the index every quarter over the next 10, 12 quarters. And then hopefully after that, you still have earning power, and
Right.
you can keep adding to it as you go along.
Right. And in terms of countries, Munish, of course, India and US, the two countries have always performed well. But any other emerging country you feel it should be part of your asset allocation in case you are running a global portfolio?
Well, again, it gets down to the issue of being able to pick managers and stocks, and that I think is a fool's errand for most people.
No, I'm talking about
So,
index, just in case you buy a China ETF or any other ETF.
yeah, I'm not a big fan of the country-specific ones.
Mm-hmm.
I would say that if you did the MSCI, you did the S&P, I think that's giving you some very uh, good diversification globally, and
Right,
some very strong businesses.
right, right, right.
No, just to give you an example, which might kind of crystallize that, is there was a there was a notion in the early 70s, late 60s, early 70s in the US of investing in the Nifty 50, not the
That's
Indian
true.
Nifty 50, but at that time, there's like, going
Yes,
back
yes,
more than 50 years.
yes.
And the theory was that these companies were so strong and so good that you really didn't need to worry about what you were paying. You could
Correct.
buy them at any price. I think I think some version of that is practiced by Saurabh Mukherjee in India.
Yeah, yeah,
And buy Asian paints at any price, and
yeah, yeah,
Pidilite at any price, and so on,
yeah,
which I
yeah,
think is heavily flawed.
yeah.
But going back to the Nifty 50 in 1970, um, there's a little bit of controversy whether Walmart was part of the Nifty 50 or not.
Mm-hmm.
Some people believe that Walmart was part of the Nifty 50, and some people believe it was not.
Mm-hmm.
If Walmart was part of the Nifty 50 at that time, and the other 49 stocks in the Nifty 50, so you did a 2% allocation to each name,
Yeah.
to the 50 names, 2% into Walmart, and then 2% to everything else. If the other 98% went to zero, and the only thing you had that continued was Walmart, and you held it till today, you beat the index by several percentage points
Okay.
with
Mm-hmm.
98% of portfolio going to zero, which didn't happen. I mean, a lot of those stocks were very overpriced, but they didn't go out of business. Some of them did go out of business, but many of them didn't. And so basically, when you look at an index like the S&P 500, um, it's a market cap weighted index, so it's not that every stock has equal weight. But let's say you go back in time and each stock in the index had a weight of 0.2%, because there are 500 names. The story would be similar, maybe not to the extent of things going to zero, but what would end up happening is that maybe there'd be 10, 20, 30 businesses out of that group which would truly shine, and they would become much larger weights. And so in an index setting, the people who run the S&P 500 index, they do make changes every year or every other year, but they usually take out the companies that are long in the tooth. Like they
Mm-hmm.
might take out a GE, but they won't take out an Amazon or a
Right.
Microsoft or Google or something. So they're generally taking out businesses which it's pretty clear that their time is done, right? And even those movements are very small. So in an active portfolio, no one held Walmart for 50 years other than the Walton family.
Mm.
And in an active portfolio, hardly anyone has. I mean, Bill Gates himself almost has no Microsoft stock. I mean, almost. I mean, Steve Ballmer's stake in Microsoft is many times Bill Gates' stake, and Steve is not the founder.
Right.
Uh, and so even the founder, in the case of Microsoft, did not keep the shares.
Mm.
And it's done extremely well. So I would say that when you go down the road of active management, the ability of the manager you choose to stick with these great businesses through thick and thin is few and far between.
Agreed.
So it's unlikely to happen. And then you have a lot of frictional costs and all of that. So that's why I think that indexing gives you a free lunch. It appears that if you pay less, you should not get as good a service as if you pay more. But in the investing business, you pay more and get less.
So I 100% agree with you, Mohnish, and I've been a strong proponent of index investing. The very unfortunate part is that people have this stereotype bias where when they see a star fund manager, they just it gets glorified, and even they're okay to pay a 2% fee. Obviously, we know that when it compounds for 15, 20 years, it takes away a lot of your gains. But how do people get rid of that behavioral bias? That's a very important point you can address.
Well, you can lead the horse to the water. You can make them drink. So I think you can give people the data and the logic and the empirical evidence. But beyond that, it's up to them. And you have a lot of very good salespeople in this industry.
Right.
And, a manager who has a good track record can use that to raise a lot of assets. And the future may not be as good as the past was.
Agreed. Mohnish, we were just doing some observation, and we saw that whenever the interest rates are going up in the US, and once the Fed has pivoted, and once the rate cut starts, major drawdowns in equity markets happen. This time around, the Fed has still not pivoted, and maybe we have some more time before the interest rates top, and after that there would be a cut, maybe 6 months or 1 year later. Mohnish, that means that we are still way behind the drawdowns in equity markets. What do you feel?
Well, like I said, if you go back to the Walton family holding Walmart over the last 50 plus years, how many actions has the Fed taken in the last half century? And what type of interest rates have we seen in the last half century? And they took no action. And they did really well. So at the end of the day, I think that it's very difficult to predict on a macro level what happens with interest rates, what happens to equities as a result of those interest rates. And if you are in the great place of having ownership of a great business, like you bought some McDonald's franchise in Peoria, the Fed moving the interest rate or whatever else, what impact is that going to have on your business, and what impact is that going to have on your business after 5 years? And the owners of these businesses, they don't see the correlation, right? Owning a McDonald's franchise or owning Walmart stock or owning Amazon stock, they're all the same thing. It's basically where I think it's probably the one proven way to build wealth is to buy into a great business at a reasonable price. And so as long as you've done that, and the S&P 500, I mean, if I look at it today, I don't think it's overvalued, and I don't think it's undervalued. I think it probably looks just fine.
Yeah.
In hindsight, we'll be able to tell whether that statement is accurate or not, but it's not like an obvious bubble is. Those are really strong businesses, and they deserve to be, in many cases, valued the way they are.
So, Mohnish, in your journey of investing, and you have authored so many books and must have experienced a lot of instances. So 2, 3, 4 things that, of course, index is one you mentioned. 2, 3, 4 things which you want to give a message to people. Just fixing those things, the other 90% keep it aside. What are these 3, 4 things if you want to keep and you want to focus so that which you have learned from your investing journey?
Well, I would say that maybe I can just give a, a brief story. Um, and this story is almost 400 years old. So in 1624, just 399 years ago, um, the American Indians who lived in the what is the now the island of Manhattan um, agreed to sell the island to the Dutch settlers in that place for $24, in the equivalent of $24. And that deal was done, and the Dutch bought the wilderness island of Manhattan at that time. And people hear that story and they think, oh, the Indians got taken. They gave away this extremely valuable real estate for nothing. But let's say the Indians, and this was a story Warren Buffett mentioned in one of his letters in the 50s to his partners, but let's say the Indians had a trust officer, and the trust officer was told by the tribe, listen, invest this money for the benefit of the tribe. We don't really need it. And let's say the trust officer was able to get a 7% return on that money over a long period of time. Now, we have something known as the rule of 72, which gives us a quick way to know how long money takes to double.
Right.
If you do 72 divided by 7, it would take about 10 years for that $24 to double to $48. And then it would become $96 in 20 years, $192 in 30 years, and so on. If you take a 100-year period, which is 10 doubles, it's 2 to the power of 10. And 2 to the power of 10 is 1,024. So let's throw away the 24 just to make the math easy. But the $24 at 7%, 100 years later would be 24,000. And then 200 years later would be 24 million. And 300 years later would be 24 billion. And 400 years later would be 24 trillion. Okay. And we are 1 year away from that at 7%. So maybe it's like 22.5 trillion or something, today. Now, what is all the land in Manhattan worth today, excluding the buildings and stuff, just the undeveloped land? The whole thing was sitting undeveloped. Well, we know that the entire wealth of the United States, the entire wealth of the world, is 500 trillion. The entire wealth of the United States is 125 trillion. Undeveloped land in Manhattan is not 20% of US wealth.
Right.
It's a much smaller number than that.
Right.
It wouldn't even get to a trillion. It'd be much lower than that. So the Indians did not get taken, because even at 7%, they would have more money than what Manhattan is worth today. So the reason for saying this story is that there are 3 things that matter with investing. The first is the amount of capital you start with. The second is your rate of return. And the third is the length of the runway. So we saw that in the case of the Indians, they started with a very small amount of capital, with a very large runway, and a below S&P annual rate of return. And they still ended up with a spectacular return. Now, if you go back, let's say instead of 1624, the deal happened in 1524. And, it's 2,400 cents in 1624. it would be the same math if it was 2.4 cents that they sold it for in 1524. So they could have sold the Manhattan for less than 3 cents, and the end result is still the same. And if you go back a few more years, you can say it would be down to 1 cent, and you would still get the same result. So if the runway is long enough, the starting amount doesn't matter. It will still become a large number. If your rate of return is low, but the length of the runway is very long, and your starting capital is high, again, you'll end up in the same place. And if the length of the runway is short, then you need higher amounts of initial capital and higher rates of return. Now, when you ask Mr. Buffett, if you could have any one wish, he always says that the one wish he wants is that when they look at his corpse, they should say, man, this guy was old. So he wants to live for a long time, not because he enjoys life particularly. I think he does, but he wants to increase the runway to as long as possible. So in the case of Warren, the compounding started when he was around 20, and now he is 92. So the runway so far has been 72 years. And it's still going. So that's fine. And so I think that what people should keep in mind is that understand the rule of 72, because that gives you a shortcut way to know how long things take to double. Understand that a tortoise can win the race, even with relatively low returns, as long as the runway is long enough. And so I think the single biggest variable that would affect outcomes for most people in terms of their investment results and so on is their savings rate. So it's not so much finding some whiz bang manager, putting it in some whiz bang fund. I think if you put it in an index fund, you have low costs. If you have a high savings rate and you continue to add to it at a pretty prolific rate, that would have more impact than anything else. And the other thing is that the savings in the early years are a lot more valuable than the savings in the later years. And so I remember that my daughter, when she was 18, she had just finished high school, and she had done an internship. And she was living at home and didn't have much expenses. So she made about $5,000 during the summer from the internship. And I asked her, I said, look, if you have this $5,000, and let's say you were able to grow it at 15% a year, which is higher, but let's say you could do 15% a year. It's a small sum. So I asked her what would be the amount when you are 68. So 15% rule of 72 doubles every 5 years. And from 18 to 68 is 50 years. So you get 10 doubles. So 10 doubles means that you have again 2 to the power of 10. So that's 1,000. So 5,000 becomes 5 million. So just from one internship, she would end up with a significant amount. And then when she was 19, if she saves more, and 20 and so on, but the early years make a big difference. So this is, I think, what people should keep in mind.
I think Mohnish explained the concept of the formula of compounding very well, where both principle and time is extremely important. And of course, time, which is really important. That's a great takeaway, Mohnish. Mohnish, you have authored many books also. Any major takeaway from those books apart from compounding that you want to take this to people? From all of you?
Well, the books were on investing, and I think the Dhando Investor is really taking kind of one line. There's a quote from Buffett, where he says that I'm a better investor because I'm a businessman. and I'm a better businessman because I'm an investor. So we have some really good entrepreneurs and business people in India. What they may not realize is that the brain cells that they use that make them great at business are the same brain cells that can make them great at investing, because they both look at the same models, they look at the same things. And so I think that the Dhando investor was basically bringing up that, look, here's the frameworks that business people use when they're running a business. And a similar framework could be used um, basically by individuals, you know, where if you're a business person, you have a pretty big leg up versus someone who's done an MBA and never run a business before, in terms of, picking your spots and so on. And on the other hand, if you are a really good investor, it gives you a lot of models that would be helpful if you start a business. And so the interplay between the two is interesting. So that's what the Dhando investor kind of focused on. And Mosaic was really a collection of articles I wrote over a couple of years, just put together in a book format. So it's really a bunch of chapters that don't necessarily kind of connect from one to the next. But I think that they are good mental models to keep in mind. So, for example, one of the things in Mosaic is I talked about how the funeral business is a really good business. And there are many different kinds of funeral businesses. For example, we have in the United States, we have the Delaware courts, similar to, I think, NCLT now in India. And there's a whole ecosystem of lawyers and advisors and lenders who work with companies that are going through restructuring and bankruptcies and all of that. Those quote unquote helpers do really well. So, because they are either involved in the burial or rebirth of companies. And so there are many different kinds of businesses which are kind of like the funeral business. So, TJ Maxx is a retailer in the US.
Yeah.
They buy excess surplus inventory from other retailers. So if you go to a TJ Maxx store, every time you go to a store or go to different stores, the type of inventory they have changes. But there may be some jeans that some retailer overordered that maybe cost them $15 a piece or something, and they would have sold it at $50. And TJ Maxx might have gotten the whole shipment at $7.
Right.
And they may put it on sale for $12, for example. And so TJ Maxx has done really well, while the retailers, which are department stores or clothing retailers, historically in the US, they have, for the most part, ended up bankrupt eventually. So because TJ Maxx is in the recycling business, it does well. So the mental model of understanding funeral homes and understanding that those types of businesses don't attract a lot of competition leads them to become better businesses.
Mm-hmm. Mm-hmm. Mohnish, you have run a fund and you have made some mistakes, and I would take this opportunity to ask you that one or two major mistakes that you made, which you don't want people to repeat. If you could cite some examples out of it or give some takeaways from there.
Sure. I think that John Templeton said that even the best investment manager or investment analyst will be wrong 1 out of 3 times.
Correct.
And probably for most of us, we'll be wrong half the time. And but this is a very forgiving business. I pointed out to you that if you bought the Nifty 50 and only Walmart was left and the other 98% went to zero, you still had a great outcome. And in fact, if we look at an investor in India who recently passed away, Rakesh Jhunjhunwala, he had put like 4% of his net worth into Titan Industries a few decades ago. And when he passed away now, Rakesh was a split brain in the sense that he held some things forever and everything else was rapid fire trading. And the 4% Titan position ended up being more than half his net worth.
Agreed.
And he did nothing, he just held it. And all the other stuff he kept doing throughout his life was the other half. So if everything else had gone to zero for Rakesh, he would still have been a multi-billionaire in dollars. So anyway, so it's a forgiving business, but what we have to understand is that we are going to make mistakes. There's really no way to avoid them because we are trying to project futures of businesses, and futures can unfold in very different ways. The important thing is to not dwell on it too much, is to learn and understand, and then not repeat that. So one area that I've had a lot of difficulty, and I've had multiple times where things have gone wrong, is investments in banks and leveraged financial institutions. So during the financial crisis in 2008 and 09, I owned a mortgage lender in the US called Delta Financial. And basically that whole world went upside down. And Delta had these, warehouse lines of credit. They were violating covenants. They ended up in bankruptcy, and eventually it was a zero for us. And it was a bet that was a 10% bet. Usually when I make a bet, it's 10%. So we were managing about 700 million at the time, and I think we took a zero on 70 million. And that repeated itself a couple more times till I learned that just don't invest. So I think one of the issues that comes up, like I've had trouble with banks as well. So the issue with, these companies like the banks and lenders, NBFCs and so on, is that for the most part, they are black boxes. We don't have loan level data. We don't have the granularity to know exactly what's in their books and what's going on. The Reserve Bank knows that, but we don't. And any business where cash leaves the door when you make a sale, like a bank gives a loan, the cash has left its premises. Right. Then they have to hope and pray it comes back. That's not a good business. So what I learned the hard way was that for whatever reason, I don't do well investing in levered financial institutions. And so what I did is I basically said, okay, all banks are off limits. All NBFCs are off limits. All lenders of any kind are off limits. I also found that studying the mistakes of other investors that highly indebted companies were more likely to have problems than not. Basically, if you're running a business where you don't have debt and you hit a downturn or a bad patch, it's unlikely you can be taken out. Right. Because you have staying power. But if you have a lot of leverage and you're tripping covenants and so on, then that becomes an issue. So one change I made was that anytime someone pitches some bank to me, I'm done in like 5 seconds. If I look at a business which has a lot of leverage, basically if a business is really good, they should be able to make a lot of money without borrowing money. Correct. That's the, like Visa or MasterCard or Coca-Cola and so on. These companies don't need any debt to make a lot of money. So it's a hallmark of a great business if it can generate high returns on equity for the long term without taking on debt. a bank does well because it borrows basically 10 to 15 times the capital it has. And then if it makes a decent spread on that money, it's a great business,
Right.
but it can go in reverse. If it doesn't do so well, the capital can go to zero.
Right.
So those lessons surprisingly took many decades to get sunk in for me, but they finally have sunk in. So that's good. Like Buffett says, old too soon and wise too late. But basically, you look at businesses and you look at your mistakes and you try to understand, was data available before you made the investment that could have stopped you if you had thought to think about those factors? And in many cases, the answer is yes. What happens is the greed part of our brain takes over, and we see the upside in something while discounting the downside. And so that's something one has to always be careful of in investing, is look for what Ben Graham would say is the margin of safety.
Yeah. I think that's another point why I think Joel Greenblatt in his book in his magic compounding method, banks and financial institutions are missing.
Yes.
He's taken that out.
Yeah.
It doesn't work.
Yeah, I think both are problematic. I think because it's with insurance companies, you get these fat tail events that show up, and then there's a problem.
Right. Mohnish, last question to you. Tell us about your journey on Dakshina Foundation, and tell us about some of your initiatives that you have taken lately, and any message that you want to give to the people based on the foundation and its activities.
Well, I think Dakshina has worked out vastly better than I would have ever ventured to guess. So it's been a good outcome. Basically, I knew probably, I would say maybe 15, 16, 17 years ago that we would end up with a lot more money than we could consume in my lifetime. And large inheritances in general do more harm than good. So you're not really helping your kids by giving them an IV drip in their arm for the rest of their life. That's not generally a very helpful way to go. So I knew that I wanted to really, because of no choice, recycle it back to society. But I also understood from Mr. Buffett that giving money away is more difficult than making it, especially giving it away effectively. So I wanted to start early. I wanted to start experimenting. I wanted to make the mistakes that I was going to make. And so Dakshina got started when I was in my early 40s. And I thought I'd probably waste 10, 15 years in India just with people ripping me off and everything else. And then I would figure out what to do. And that was, from my point of view, the tuition bill to pay. But actually, we got traction from day one. So our model worked. We had cloned our model from a guy in Bihar, Anand Kumar, who runs Super 30. And I think the government is giving him a Padma Shri now, which is great. And so we identify very poor kids who are gifted, and we prepare them for these competitive exams like IIT and medical and so on, where they would not be able to, afford it. And in many cases, they're in rural India, so there is also nothing offered. And we've had about 6,500 kids go through our program in the last 15 years or so. And, about 4,000 odd of them have gotten to IIT or med school and so on. And even the rest have got to like some good engineering colleges and so on. So it's worked out well, and we are trying to grow and scale it. So it's been great.
Excellent, Mohnish. So Mohnish, you have been sitting with the great investors, Charlie and Warren Buffett. 2-3 conversations that you have with them all the time in regards to investing, which have always stayed with you. What are those? I mean, if you could just share. investing or
Well,
life?
I would say the thing that I've observed and learned from both of them is that they fixate a lot on the downside.
Hmm.
Um, they a lot of investors get excited about the upside. Their minds, because just observing them, the way they are wired, they immediately start thinking about what can go wrong. And what they're looking for in investments is they're looking for total no-brainers. So they're looking for opportunities where the odds of things going wrong are very low. They still make mistakes. But what I learned is that if you put your focus on the downside, which is the opposite of venture investing. If you're doing venture investing, you ask yourself what possibly could happen on the upside. And you're more of a dreamer in terms of what great things could happen. This is the exact opposite, where you're questioning yourself repeatedly on what can go wrong. So that's what I think is kind of the margin of safety that they talk about, and then the circle of competence.
Okay. Since you mentioned venture investing, of course we know that last 2 3 years, 2 years has been pretty difficult for them, and so do you really feel that private market investing is better than public market investing, or public market investing will always win in the long run?
I think venture investing is a very difficult game.
Hmm.
If you look at all the different venture funds in the US, the results of the top 2 or 3 or 5% of firms versus the rest of the industry is night and day. And if you look at the top quartile versus the bottom quartile, there's a very large difference. If you look at the top 5% versus the next 5%, it's a very large difference. So, whereas if you look at different bond fund managers between top and bottom, there'll be almost no difference. So venture, I think, is a very difficult asset class, I think, because to do well, you would need access to funds that probably are very difficult to get access to.
Agreed. Agreed.
And then the funds that you would get access to are
And
probably
average.
not in the top 5%.
Agreed. Agreed. Great. Thanks, Mohnish. Thanks so much for your time and taking on today. And if I can be any use to your foundation, I'd love to participate with myself and my team any point of time.
All right.
Which part of US you are, Mohnish? I'll just stop the